Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. He's speaking to us from Vancouver. Welcome back to the show, Bob.
Yeah, Jim, here we are. A lovely Friday at my end of town.
Yes, and I'm about 20 miles away in New Westminster. It's still overcast, and I'm still watching huge amounts of flood debris come down the Fraser River.
Oh, yeah. Terrible floods right up the valley, and the whole drainage system is, man, we're talking about geological terms here with this one.
Yes, all the major highways from Vancouver east have been cut, and so have the rail lines. So if you thought there were supply chain problems for products from Asia, from Vancouver, that go through Vancouver, they're about to get worse.
Yep.
Yep.
And this one is geology. It's the way you get these huge torrential rains, and this one was extraordinary.
Yeah, and you can't just blame them for building farms on a floodplain. We live right up next. BC essentially is just one continuous mountain range, one after the other.
Yeah.
And when you combine record rains with mountains, bad things happen. Nothing you can do about it.
No, you got high rainfall and steep valleys. That's what happens.
And like I said, I'm watching, it seems to me half the forests of British Columbia float by.
Oh, yeah.
So anyway, from the floods here, and best of luck to all the people dealing with it. The farming community in BC heavily hit with this because the area that's been flooded supplies half of our chickens and eggs and dairy products.
Yeah.
So we love to answer listener questions. Our first one comes from Michael. Hello, Jim and Bob. Wow, that Christmas rally started early this year, but the market timers say it has a lot more steam, and this vertical bull run will continue into the new year and likely into April. Now, here's your favorite, the South Sea Bubble. The South Sea Bubble has been eclipsed in magnitude by Bitcoin, and now apparently by the U.S. indices. Analysts are raising their targets ever higher. Bob, given the amount of margin debt and investor euphoria, will the market run out of steam like in November, December 2018, or like that sell-off from late 2008 into 2009? Also, will the U.S. Fed sacrifice the American dollar by keeping interest rates low so as to continue to support ever-rising stock prices? I think that's a great question, Bob.
It's a long one. And it has been vertical, but one of the things we look at is the advanced decline index, and it was acting toppy for a number of months, and then with the latest rush, straight up. But in looking at it today, it's reversed and is giving a warning. And the other one that has been helping the bubble is the credit spreads. The one we watch is CCC versus Treasuries. And as of today, it will have broken out to widening. The trend reversed. The narrowing went into about June, and then it reversed, but then it was flat ever since. But now, so you've got two things going on here. The advanced declines are now giving a negative divergence on the stock market, and the credit spreads are widening, and this is rather ominous as well. Now, you mentioned the South Sea Bubble, which I guess I've been interested in that one for a long time. The lead stock on that was, of course, the South Sea Bubble, a quasi-government company that They figured out all kinds of financial wizardry with the thing, such that it ended up paying off a huge debt problem that the government had after a major war. But you can say that stock was about 10 times on its, sort of from 100 pounds to 1,050 pounds. And then other bubbles, 1772, 1825, 1873, 1929, your major stocks in the final year and a half would have been, say, a 10-bagger. But what you have here with the Bitcoin, and you're appropriate to put it in, is that it's a big cap phenomenon, and the price percentage changes are immense. So that, to me, has been saying that the huge inflation, hyperinflation, is in the market, and it is in financial assets. And you get the equivalent of a stock, make those percentage gains. Sure, you can get that with junior mining stock if you got them at a penny or 2 or 5 cents and they go to $20, yeah. But I'm talking about big cap things here, and the Bitcoin crypto has accomplished the biggest price gains in history. So here we are, and you also mentioned margin debt. Yeah, and recently it spiked straight up. So the street is leveraged. And I think, what I wrote yesterday, Michael, was that two things you can count on. You can get a Santa Claus rally. Then my colleague Ross is very good on the small cap phenomenon, where from about the middle of December into the first week in January, the small caps will outperform the big caps. And then you've got, and you can also have a special market phenomenon going straight up peak in January. Many of them have over the years. I've used it many times, but I don't think so. We're getting immediate stuff now with the reversal in the advanced decline line. You've had a tremendous hit in crude oil today, and ages ago when crude oil went up, stocks went down, but not now. It goes up and down with the market. So, and whether the Fed can do anything about this, no, it's done all it can. And they often like in 2007, in September, I remember it well, on that cyclical bull market, short interest rates went up, such as Treasury bill and Fed funds. So then you had the standard Wall Street pundit in September of 2007 saying all is going to be okay because the Fed will cut interest rates. They called it the Fed cut. And of course then that's when I throw in some history and point out that in any cyclical bull market or any cyclical business expansion, as it completes, short rates go up. And then as it fails, short rates go down. So you have, and also pointed out the irony, that at times, in the worst part of the decline in stock prices, interest rates will fall the fastest. So this then was complete error at the time, but it was standard fare among Wall Street spokespersons. But now you've got interest rates almost at zero. But one came out last week, and what it wasn't the claim that Fed cut will keep the mania going. No, it was that QE will keep the mania going. So this then gets into, they're going to throw more money into the market, but if you look at the history of cyclical moves in credit markets and in stock markets, when it's time for it to go down, it overwhelms the Fed's ability to keep it going. And this is where, Michael, you mentioned margin. And then once it's over and you got that margin to the moon where it is, then the power shifts from the Federal Reserve, who want to inflate the bubble, and the power shifts to the margin clerks, who have to get the accounts in line. And it's classic ancient old stuff. And it goes all the way back to the South Sea bubble in 1720. And thank you for the question.
Our second question comes from Andrew. Andrew emails us. We are seeing a trend with these lockdowns that appear randomly in different countries, which suggests government is pursuing stop-and-go policies aiming at causing rising costs to business in their attempt to deliver inflation. Their measures, of course, appear to be not working, matching the experiences of their brethren at the central banks. Which sectors have historically done best, and which the worst during such stop-and-go periods and coming out of them? Thanks, your friend Andrew.
Thank you, Andrew. Yeah, that's kind of a difficult wrap on that one, because stop-and-go policies, you haven't had them before. So which sectors, there's no evidence of which does better and which doesn't. But I would prefer to look at it just at the end of a bubble, whereby as it heads south, most stock prices will be going down, most sectors, but we know that out of a post-bubble or one of the features of a post-bubble contraction has been gold's real price going up, and that enhances profitability of mining, and the gold stocks perform very well in post-bubble contractions. And then the other thing is just protecting yourself against asset prices going down. And if you go to bank deposits or T-bills, you're going to get zero. So there's one thing that somebody familiar with the bond market could consider, and that's to look at high-grade corporate bonds, particularly U.S., maybe a 4-year maturity. You're not going to get banged in price. You're not going to get stiffed on risk. And also, with the U.S. dollar probably continuing to go up, it is now broken up out to the upside. Those in Canada can enjoy a slightly better return, not too bad on the risk, and make a little extra out of the U.S. dollar going up. I kind of like that trade for very safe money. The other one we would, of course, recommend is for outperformance when they bottom. Gold stocks. They've had a rally recently, but it's not quite the bottom we were looking for, and I think when the time comes, we'll be able to use our technical stuff to call for the next terrific opportunity in gold stocks. So, I'm going to add one more thing to this, Jim, is that in the post-bubble contraction, gold stocks not only go up, but they will outperform the S&P. And we had that from our buy in November 2018, and then the high was very strong high momentum high in July 2020. And on that one, you take the GDXJ, and its gain was more than twice the gain in the S&P on the same move. But our advice then was the sector was overdone, and we're going to get a lengthy correction. So the correction is not yet complete, and we're looking for the next opportunity in the gold sector. But Andrew, thanks. You're watching the market well, and that's a good question.
Bob, something I saw on Bloomberg BNN today, an oil and gas analyst saying they expect natural gas prices to remain high and to perhaps skyrocket because of the pressure from all the I almost call them terrorists, but let's say alarmists. No more oil and gas exploration is taking place, and eventually even the extensive natural gas fields will start running out, and that will boost prices even more because we have in no way weaned ourselves from using natural gas, which is a very efficient way to heat and cool our homes.
Yeah, over the last year, back in January, we were looking for a good rally for industrial commodities out to mid-year, which we got. And then what has happened since August has been a rotation into suddenly hot commodities. All of a sudden you had to own aluminum. All of a sudden you had to own natural gas. But each of these has reached technical excesses, which of the ones we've been following, we've noted. And the surprise in here will be the U.S. dollar continuing its rise and possibly a post-bubble contraction coming in. So we're in a period where seasonally maybe natural gas still has a little more in it, but it did reach a huge excess a while ago. But this goes back to Joe Biden's first utterance, which was to shut down oil and gas business in federal lands. And if they could have done it in private lands, they would have done it as well. So, I mean, that was the easy call, that energy prices would soar. But you've got, they've rallied hugely. And as each one gets overbought, we've been able to identify it. And recently, lithium still going up, cobalt, but things like steel and iron ore and coal, they've been heading down. So I think the thing, Jim, to watch for is that as this U.S. dollar continues to rally, all of the items that the inflationists have been bidding up will become even more vulnerable. So we're in a state of transition, and with interventions are just absolutely unheard of before, because you got a bunch of crazies in the U.S. administration. It's not Joe Biden's senility that's doing this. This is just straight out Marxist Democrat policies. And one major Democrat the other day said, well, we want you all to go to bankrupt, stating it to the energy business, I guess, or something like that. So, yeah, we are in crazy times.
We'll have more with Bob Hoye right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. We're going to take a look at some headlines Bob dug up for us today. The first one, U.S. farmland values rise the most in a decade. What's the story there, Bob? I guess we all have to eat.
You've had big wealthy people accumulating a lot of land. You've had now a year of rising grain prices, so that makes the Midwest attractive. They're buying it, but historically, I actually can find an index of U.S. farmland values. I think it goes back to the 1920s. I haven't looked at it for a while, but the only historical one I have is in England, when it was the senior economy. There was a great bubble that completed in 1873, and then it went into a long 20-year depression, and economic historian, put together an index of farmland values in England. And this is, Jim, just off my memory. So maybe the index was at 58 in 1873. And then by 1895, which was the bottom of that Great Depression, it was down to, let's say 38. And no year or a couple of years with an uptick in it, just straight on down with that post-bubble deflation. So it's interesting here that you have a huge bid for farmland, and at the height of a great financial bubble, from which we're going to get a post-bubble contraction, and at some point this speculation in farmland will fade, and the sector will decline. Same with residential real estate and commercial and industrial property. It's all part of the big bubble that will then be marked down as you go into the post-bubble deflation.
Headline: China property market hit by rare convergence of supply and demand disturbances.
Yeah.
Is this more fallout from Evergrande?
Yeah, it's spreading to others. And remember, a week or so ago, we discussed I'd come across a Chinese junk bond yield index. And I thought the article was about Evergrande bonds, and they were trading up to a 25% yield. And then as I read it more closely and got onto the chart, no, that's an index of junk bonds. Evergrande would be worse, and then there's others. So you have this monstrosity going on, and historically, when you've had I used to call them lesser markets, but China is so big that let's call it an outlying market. It's outside of the financial centers, has long been New York and London. So, and when they go bad out there, and it started last March with Turkey, Argentina, and then again Turkey in headlines this week, and China is in a horrendous mess of. Didn't you say that there's something like 150 million empty residences, apartments?
190 million.
190 million
empty
units.
Properties, yes.
Yeah. Now that is not going to be cleared by a central bank fiddling around with QE. The only way something that misbalanced can get cured is by having the prices fall to the point where the property falls into stronger hands. And it's in weak hands now. So it's classic old stuff. But, Jim, it is certainly going to be interesting.
You saw a headline where President Biden has asked China to produce more oil. China does produce a lot of oil. It's seventh in the world when it comes to oil production. Now Canada, I'm just checking our thing. I think we're like, I don't know, maybe third, something like that. I think we produce more than Saudi Arabia now, 3.7 million barrels per day. And let's see, the U.S. soaks up 98% of our crude oil exports.
Yeah, I guess they do.
But anyway, so I may be wrong about Canada's position in the world, but China is a major oil producer. Is it ironic that the U.S. president has asked China to produce more oil because it would help reduce gasoline prices in the U.S.?
Yeah, it's not just ironic, Jim. It's stupid because, as I said, one of the first things he did was to shut down oil and gas as best he could in the U.S. And, of course, that's on Obama's mission to get rid of all fossil fuels. And I still have it in my mind, a video clip of him saying, and, of course, these prices are going to go up, but we're going to have to do it. And then when prices do go up and the public protests, and also what's really getting them is the shift in potential Democrat voters and independent voters over to the Republicans. They're losing their rank and file voter, and so then all of a sudden you have this idiotic move and a month or so ago it was asking OPEC to increase their production to lower prices. But would they say to American oil and gas people, go ahead, we love you, we want you to back in action again? No. So they ruin or attempt to ruin the oil and gas business in the United States and then plead with foreigners to help push the prices down. I mean,
Well,
It is
Biden
just
doesn't
so
like
pathetic.
Right, Biden doesn't like Canada either. He ordered the XL pipeline shut down immediately. That was his first order as president. Canada is the 5th largest oil producer in the world, but Biden would rather get oil from Saudi Arabia and China rather than from Canada.
Yeah.
Yeah. So
no, it's they're. I think the term mad comes to mind. Not the mad meaning angry, but mad meaning any loss of rational thought and behavior.
Yes, and you know that expression, mad as a hatter?
Yeah.
Well, the people who made hats back in the 1800s, mercury is part of the process of shrinking the felt. And so that would attack their brains, turning them insane. And that's where mad as a hatter came from.
Yeah. Well, the Democrat Party has fallen in the hands of radicals. Now, here's something ironical, Jim. Mm-hmm. What they're doing, most normal people look at and say they're crazy. But then the left looks at people resisting their plans, resisting masks, resisting vaccinations. So the left says to those people, you're crazy. But the answer to this is to look in the past at previous examples of when the authoritarians go crazy. And I've got a lot of history on that, and the craziness is intruding price and wage controls in Roman times, and massive intrusions in the 1500s, and massive intrusions now. And so the result is that if you are in a peace and orderly country with freedom, there is prosperity across the economy. And if you are in a country that is authoritarian and economic and personal freedom is gone, you are in poverty. So this then becomes the answer. Is yes, what the Marxist Democrats are doing now is absolutely crazy because it leads to widespread poverty. And those of us who are criticizing it, hey, we're quite sane, rational, and not crazy. But in the minds of the far left, any resistance to their persuasions is considered as some sort of craziness. I mean, you're not with the picture. But I think all of this will change as the financial markets roll over. The wild speculation in financials will deflate. And I also think that the wild action in political markets will deflate as well.
Mm-hmm. And if anybody thinks wage and price controls work, back in 1975, Prime Minister Pierre Trudeau passed the Anti-Inflation Act. And that's when I joined the workforce, 1975, just graduated from high school and went into radio. I can tell you, it kept wages down, but it did not control prices. Yeah. Because what can a country smaller than California in population terms do to control outside supply prices? Nothing.
Yep. Oh, yeah. No,
absolutely nothing.
Actually, at the time, I wrote a letter to the editor pointing out that because they imposed price and wage controls in Canada and in the United States, and then they really expected this to work. And then they realized it wasn't working. And then I don't know which politician in Canada, but they said, we have to put some teeth into the laws, more stronger penalties, and then it'll work. And I think in a letter to the editor at that time, I wrote that the Emperor Diocletian in 305 or something AD, he imposed price and wage controls, and he backed it by the sword. So if you were accused of not having the right wages or the right goods prices, you got the chop. And it didn't work. They got off of it. So, again, that price and wage controls, another example of bureaucratic madness.
Well, if you don't want to be accused of charging too much for a product, then you just don't supply that product.
Yep.
Yes, that's exactly right. And that reminds me of the origin of the baker's dozen, 13 buns instead of 12. If you shortchanged a client or a customer on a bread supply, I think the penalty might have been hanging back in those days in England.
They were severe ones. I've got a chart that shows in Belgium or somewhere in the 1500s, which was a century of inflation, and when it was particularly sharp, or surging inflation, the average size of a loaf of bread diminished tremendously. So the price stayed the same, but the product became smaller. And again, civil authorities tried to do something about it, but the problem was that it was the governments that were depreciating the coinage, and thus forcing the inflation. So.
Yes, the baker's dozen, according to the Oxford Dictionary, originated in the late 16th century. To stop bakers from shortchanging their customers, so they added a 13th loaf of bread just to make sure they weren't short. Now, I'm not sure of what the penalty was, but I can tell you back in the 16th century, most penalties involved death, and quite often a very gruesome one.
Oh, yeah.
Yeah. The more gruesome, the better, as far as they were concerned. Now, another headline that caught your attention: America's largest pension plan approves leverage to meet its targets. Does that mean they're going to make very risky investments?
Yeah. This one is sad. It's the California Employers Pension Fund, CalPERS, $400 billion. And so with the artificially lowered interest rates across the board, these pension funds have actuaries, and they know what the future demands of the pension will be. So they have to match that with returns from the investment thing. But when you've got repressed interest rates, you then have to go to buying equities rather than just straight income items. And then within the income items, through most of history, and I wrote an article ages ago on Sun Life out of Montreal as absolutely outstanding life insurer. And they most of the time from investment grade bonds you can get enough return to satisfy the actuaries, and then with the suppression of interest rates, they've had to buy junk, which is risky, and then returns in junk are not adequate to meet the actuaries. So they now realize that even just buying straight equities is not going to do it. So some econometric guys with their models have come up with that they can get a somewhat better return out of employing some leverage. And I note that they're considering this at tremendous highs, huge overvaluation in the stock market, and unprecedented overvaluation in certain aspects of the bond market. So I think this is going to be a major blunder, but the sad thing is that it's insane central banking policies that are forcing pension fund managers to do risky things, and not good at all. It's I hate it. It's awful.
Now we have another headline here. Buyouts or buy-ups, buying back stocks has hit $1 trillion. Bob, you remember a time when it was illegal to buy back your own stock because it was considered market manipulation. When did they change that law? And is it a good idea to allow companies to buy back their stocks?
Yeah, I can't remember when it changed it, but
82, something like that?
It became in a dull market, certain stock market operators became ambitious and figured out ways to enhance their own stocks. Now, one of the most evil examples of it was with Boeing Company and the redesign of their 737 MAX, where they scrimped upon not just mechanical engineering on the design of the plane and the placing of those huge new jet engines, but also in the software and the engineering program. So they scrimped on designing a plane, and at the same time they spent $45 billion buying their stock. And that, to my mind, is just plain evil. But hey, in a stock market party, anything goes. But no, this is a future critics of what's going on now will lay it all out. But it's not probity. It's not wise. It's not careful. It's totally insane, because the central bankers are running insane policies where they think that if they ease credit, it'll make the economy go up. But when the economy doesn't want to go up and it's time for stock prices to go up, then all the action goes into the stock and bond markets. So it's the same as the 1920s. You had the huge boom in commodities to 1920, huge crash in commodities, major deflation, and the central bank, the Fed, was concerned about deflation, so it was chronically easy in money supply, not understanding that a huge inflation in financial asset was on, and even then, after the crash, they still don't understand it. So here you have now, for a large part of the last decade, the Fed has been saying that inflation is not high enough. And then they've been providing easy money in a period that turns out to be a decade long of inflation in financial assets. And then all I know is that after every great financial bubble, everything deflates. So the Federal Reserve has made the exact same mistake it made in the 1920s, and then on the actual corporate affairs, these guys are doing stock buybacks. It's financial manipulation. It's promotion. It's not straight up proper dealings. And but hey, nobody's going to do anything about it. And the directors of the company are the ones that are conducting this policy, and at some point they're going to have a major problem on their hands.
Bob, some of your historic knowledge is rubbed off on me. It was 1982 when the SEC changed the rule allowing companies to repurchase their shares.
And that was the end of the bear market. I haven't got the chart in front of me, but if you deflate the S&P by the Consumer Price Index, you had a peak at about 1968, and then again, because this action shifted over to commodities and stocks and bonds did not do well, and then that ended in, I guess it was March of 1982, or thereabouts, when the stock market bottomed, and again, S&P deflated by the CPI. I think it was down over 60%. So that was a bottom of a lengthy bear market, and of course the whole of the street was doing everything it could to try and make a better stock market. So, and thanks for pointing out when they did change that. And then that was the instant when the whole world turned to inflation and financial assets, and it's been on ever since. And now I would suggest that inflation and financial assets is now crazy and due for a setback.
And I did some quick research on the penalty for shortchanging your customers when you sold bread back in medieval England. It was flogging or the pillory, which we would know as stocks, where you stick your head and hands through the wooden frame and then people throw rotten vegetables at you.
Yeah.
So that's why they always made sure their customers got enough bread and they weren't shortchanged.
Yeah.
Bob, always great talking with you, and it's
Well,
always an education.
Thank you, Jim. We had some fun today, and look forward to next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. If you have any questions for Bob, he'll gladly answer them. If you send them to info@housestreet.com, our YouTube channel is Talk Digital Network. Find us on Twitter @HouseStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.